Hello, everyone. Thanks for joining us on this beautiful Friday. Um, it is September 27th, and my name is Deanna. I work for Tempo Family of Funds and Syndications. I am the Director of Investor Relations, and our main host is Big Mike. Thanks for joining us today, Mike. We are hosting Brandon Hall. He is a CPA that we've had on before. Actually, he has one of our most popular videos on our YouTube channel about understanding your K1s, and we're just excited to have him on again today. It was, I guess, one of the most anticipated lunch and learns that we've hosted, and we always look forward to being able to answer some of the tax questions through CPAs, especially because we are not CPAs. So I just want to remind you, the disclaimer for today is that this is an educational webinar. And if you would like some financial, legal, or investment advice, please consult your professionals. And if you would like to see about working with Brandon for your tax situation, please make sure to reach out to his firm. It's Hall CPA. We'll have that contact information available for you soon too. But I just want to make sure that we have enough time today to answer everyone's questions and also get through the presentation in a timely manner. So Brandon, thanks for joining us again. Go ahead and start presenting in however format you feel comfortable. I know that you are a busy man, and so I want to make sure that you have all of the ability to host. Let me give you that permission right now. There you go.
Thank you. Just about to ask for that. No, I appreciate being here. So thank you very much. It's good to be back. And we are currently going through the tropical storm. I live in Raleigh, North Carolina, so it's not bad for us by any means, but it's getting pretty gnarly outside, and we have some tornado watches. So if I just disappear, that's what's going on. But anyway, good to be here. Today, I'm going to blow through a presentation on the passive activity losses. The reason I'm going to blow through it is I know that you guys have some questions queued up. And I just want to make sure that we kind of get through all of those, either the pre-formatted questions or any questions that come out of this presentation. But what we're going to do is talk about the passive activity loss rules. And the reason that we're going to talk about them is I find that they are the most misunderstood rules for real estate investors across the country, and for, frankly, a lot of their tax accountants as well. We are currently helping on, I think we've got like 10 active IRS audits right now on real estate professional status, short-term rental loophole, that type of thing. But it's all embedded in the passive activity loss rules. And these 10 audits are all, I think 9 out of 10 of the audits are new clients who came to us when they had the audit ongoing and their tax pros just couldn't help them. So it's just, this stuff's really nuanced. And I just want to make sure that everybody really understands the fundamentals. That way you can have more sophisticated conversations with your own tax pros. So let's go ahead and jump into it. Before we begin, let's talk about why you should care. Everybody is subject to the passive activity loss rules. Okay, so everybody here on this call, everybody in the United States is subject to the passive activity loss rules. Now, we typically don't figure out that we're subject to the passive activity loss rules until we own or invest in rental real estate. And the reason for that is the passive activity loss rules primarily center around rental real estate. However, they also apply to businesses that we don't actively participate in. So the important thing is just to understand first, you are subject to these rules. And so is everybody else, every single taxpayer in the United States, whether or not they realize it. But the second thing is this concept of time value of money. So the passive activity loss rules, as we'll find out here in 1 second, prevent us, or they are meant to make it harder or prevent us from using rental losses to offset our regular income. And if we can't use rental losses to offset our regular income, then the losses become suspended, and we can't get the tax savings today, right? And so this concept of time value of money, where the basket of goods that we have today is cheaper than the basket of goods tomorrow. The dollar, if you have $1 bill, an actual cold hard dollar, it's not going to be able to buy the same basket of goods a year from now as it does today, right? That's the time value of money that these things increase over time. So that's happening with our tax savings too. So if you think about that, if we're not going to extract tax savings from our rental real estate, then we are losing this benefit of time value of money. We are losing the value to inflation over time. And so the idea is we want to extract those tax benefits as fast as we possibly can. And in order to do that, we have to understand how the passive activity loss rules work. Because if those losses become suspended, we're not getting the tax benefit today, and we're not maximizing opportunities under the time value of money. So the history of the passive activity loss rules, these rules were implemented back in 1986. So prior to 1986, you could be a high income earner and a landlord, and you could use your rental losses to offset your regular income. No issues, right? So prior to 1986, great time to be a landlord. Everybody loved it. And I was actually I was not alive in 1986. So I'm guessing it was awesome. But from a tax perspective, it seems pretty awesome. Now, the passive activity loss rules came into play because Congress said, hey, we don't want rich people to be buying rental real estate and just completely nuking their income. We want them to pay taxes. So they created the passive activity loss rules. And the passive activity loss rules created two types of passive activities. So the first is any rental activity. That's the first bullet point that you see there. Any rental activity unless you qualify as a real estate professional. So that says any rental activity unless there's an exception under IRC section 469C7, and that is technical speak for real estate professional status. So if you qualify as a real estate pro, then you're good. But otherwise, you have a passive activity. The second bullet point is any trade or business that the taxpayer does not materially participate in. All right. So one common theme with real estate professional status is, somebody will qualify as a real estate pro, but their rentals will actually still be passive because they actually don't hit that second bullet point of any trade or business that you do not materially participate in. So if you don't materially participate in your rentals, they're still passive, even if you qualify as a real estate pro. And we can get to that here in a few minutes as well. But the important thing to understand here is that prior to 1986, no issue, buy real estate, accelerate your depreciation, use the losses to offset regular income. After 1986, all of a sudden, rentals and passive business activities were placed into this bucket. I'll call it the passive bucket. And then everything else that we have, right? Our W-2 income, our business income, interest income, dividend income, capital gain income from stock sales. I know that all sounds passive, but essentially it all got put into this non-passive bucket. That's what they call it, non-passive. So you've got a passive bucket and a non-passive bucket. Think of it as an island if you want, a passive island, non-passive island. The passive island is definitely having more fun than the non-passive island, but regardless, but the two separate islands of income, but there's no bridge, right? So if they're stuck, if the rentals are stuck on passive island, then you can't just move them over to non-passive island, or you have to find an exception to move them over to the non-passive island. Otherwise, the rental losses just get suspended and carried forward. And the same kind of concept applies if I invest as an LP into a real estate fund or syndicate. That's all passive, right? Those passive losses cannot be used to offset my non-passive income unless I qualify for an exception to these rules. So why were the rentals passive? Well, Congress is like, hey, look, rentals generally produce cash flow, but at the same time, a tax loss. So they're basically saying, these landlords are telling the IRS that they lost money even when they made money. And that's thanks to this concept of depreciation, that sheltering effect that depreciation gives us. So Congress said, that's not fair. We don't want rich people, again, making money on their investments, but telling the IRS they lost money and being able to use that loss to offset their W-2 income or their business income. So we're going to block that. And again, that's where they put rentals into this one separate bucket completely by themselves. Those losses, if you can't use them, become suspended and carried forward. And you can use them eventually to offset future passive income, future gain on sale from a passive activity, but you can't use them today to offset your non-passive income. So two examples to help kind of hit home. Let's say that you have a rental, $40,000 of expenses, $40,000 of revenue, $30,000 of expenses, depreciation is $20K. So revenue minus expenses, we have $10,000 of net operating income, right? Revenue 40, expenses 30, $10K net operating income. If we didn't finance this thing, bought it 100% cash, then we could also call the $10K cash flow. So the $10,000 actually hit my pocket, right? But the depreciation that we get to report is $20,000. So I get to tell the IRS I lost $10,000. Okay, very important concept to understand. $10,000 actually hit my pocket. That's cash flow. That's my net operating income. But I get to tell the IRS that I actually lost $10,000 because $10,000 of positive income minus 20K of depreciation equals negative 10,000. All right. So the 10,000 that hit my pocket is sheltered today. And that is a big benefit of investing in real estate that everybody tends to overlook because we get so focused on the losses. But when I have clients that are LPs in syndicates and funds, they'll come to me and they'll say, hey, I have a $70,000 loss in my K1. And I'm mad at you guys, me, the CPA, because I wanted to take that loss against my income. So they're not understanding the passive activity loss rules, right? They don't understand that the 70K is passive to them and it can offset other passive income. But if they don't have passive income, it gets suspended and it gets carried forward. You can't use it to offset your W-2 and business income. So we explain that, they get all upset. But then I try to explain, they will say, well, I don't understand why I'm investing in real estate. Then there's no tax benefit for me. And that's where I then explain, well, wait a second, you still had cash flow from this investment that you didn't pay tax on today. And you'll probably have future cash flow that you're not going to pay tax on today. And that is a big benefit of investing in real estate. And it's illustrated by this example. Revenue minus expenses is $10,000 of cash flow. But now I also have 20K of depreciation expense that I'm reporting on top of that. So I get to tell the IRS I lost money even when I made money. Now on the left-hand side, we're assuming, hey, those losses are passive losses. So that $10,000 of loss gets suspended and carried forward. But on the right-hand side, if I can qualify for an exception to the passive activity loss rules, that means that I can make the loss non-passive, meaning I can take the rental across the bridge and put it onto the non-passive island where all of my other rental losses are, or all of my other income is, right? My W-2 income, my business income. And that means that $10,000 loss can now offset my W-2 income and my business income. So if I can qualify for an exception to the passive activity loss rules, I can make that jump. And if I can make that jump, now that $10,000 tax loss actually saves me $3,700 in taxes at the highest tax rate, of course, but you would apply your own marginal tax rate to this situation. So if we then add the concept of bonus depreciation to this, now I've got the same revenue and expenses, right? So my NOI is still 10,000, but now I've got $60,000 of depreciation expense. So now I'm telling the IRS that I lost $50,000. So if the losses are passive, then $50,000 is suspended and carried forward on my tax returns. If the losses are non-passive, now I get a tax benefit of $18,500, assuming again that I'm in that top tax bracket. So again, understanding how the passive activity loss rules work and understanding the exceptions to the passive activity loss rules can help you build a portfolio that is fully tax optimized. All right. Before we get into real estate professional status, which I'll kind of breeze over because I think this is a more like LP passive group. I did want to talk about specific strategies for LPs. So first things first, when you are investing as an LP, everything's going to be passive for you. Okay. So you need to be thinking about longer term strategies and potentially even pairing it up with non-passive activities, which we'll talk about here in a second. But one of my favorite strategies was actually not here on this slide, is something that I like to call passive activity netting. The way that this works is, let's say that and let me preface it by saying passive activity netting is kind of like Rich Dad Poor Dad on steroids. If anybody's read the book Rich Dad Poor Dad, passive activity netting is Rich Dad Poor Dad on steroids. And it's a beautiful concept because you don't have to jump through any of the hoops to qualify for an exception to the passive activity loss rules. Otherwise, qualifying, getting your rental off of that passive island and moving it over to the non-passive island or buckets or whatever, it's actually pretty hard to do. Like, it requires a lot of work to qualify for one of the exceptions to the rules. So if you are instead just a passive investor and you want to think a little bit more long term, you can actually utilize the concept of passive activity netting. And it's easy because you don't have to do you don't have to jump through any special hoops. So here's how it works. So let's say that I put $200,000 into a real estate fund, and I receive back $100,000 tax loss on my K1. That's a passive loss. If I'm an LP in a real estate fund, I cannot possibly qualify that activity as material participation. I could potentially group that in with other rentals that I'm managing myself. And, we can do the grouping election, which is beyond the scope of this presentation. But that 100K that I get back, from the K1 saying it's a tax loss. That $100,000 is a passive loss. Now, if I also go and invest in my local hair salon, and this is actually example number 2 here. So let's say that I go and invest in my local hair salon. I put $100,000 into it. They want my money for expansion capital. All right. So they say, give us 100,000. We will give you a profit interest stake in our business, meaning that I'm going to receive profits back every single year as a result of placing this capital. But Brandon, you don't know how to cut hair. You don't know what it requires to run a hair salon. So all you are is a capital partner. You're not allowed to be involved in operations. You don't have voting rights, nothing like that, right? So I'm not actually participating anywhere in this hair salon. I just put up $100,000 and I'm getting a slice of the profits every year going forward. Those profits that are coming back are passive income. That's passive income for me, right? Well, guess what can offset the passive income? The rental losses. Rental losses that are passive, those are just passive losses, and passive losses can offset passive income. It's a really awesome way to create a portfolio of businesses and real estate that nets out against each other. So you can quite literally have cash flow from the real estate and cash flow from the business and not pay tax on either. We have a handful of our clients that do this, but it's I wish all of our clients would do this, but the problem is that most people want to not pay tax today and they don't think long term. This is a multi-decade strategy, right? It's not like you can't just overnight start placing all that type of capital and see those benefits. But if you create a long-term plan and you kind of say directionally, I want to invest in businesses and I also want to invest in real estate, man, you can create a life 15, 20 years from now where you are making a significant amount of cash flow and you're paying $0 in taxes on it. And that is one thing I love about real estate, and that is called, again, passive activity netting. Example number 1 here is kind of a similar example. It's a physician who invests in a surgical center, and this actually came from a tax court case called Hardy versus Commissioner, I think back in 2012. But the physician had a rental portfolio. The rental portfolio was producing losses. The losses were passive losses. But the physician also invested in a surgical center. Now, the physician used the surgical center for his surgeries, but he wasn't actually a part of the surgical center's operations, management team, anything like that. So he was actually, even though he invested in the surgical center, and even though he used the surgical center, his investment in the surgical center was passive. Now, I don't know if you know how it works with physicians and surgical centers, but surgical centers typically produce some pretty significant cash flow. So Hardy, the taxpayer in this example, had a lot of cash coming in from the surgical center, and he was using the rental losses to offset the surgical center income because rental losses are passive, surgical center income is passive, passive losses can offset passive income, right? IRS didn't like it, audited them. They all went to tax court to figure it out, and Hardy ended up prevailing in tax court. So again, it's just a real life example of how do you run this passive activity netting idea, right? It's rental losses offset passive income, passive losses offset passive income. So Hardy did that, didn't have to qualify as a real estate professional, didn't have to jump through any special hoops, didn't have to worry about material participation. It's just getting a little bit more strategic about how do I make investments and the timing of my investments as well. I did want to touch on the last example there. One more example that can help you, or one more idea if you are a limited partner investing in real estate funds or syndicates, is something called the lazy 1031. So you can't 1031 exchange partnership interest, right? So if I invest in a real estate fund or syndicate, I own a partnership interest in that real estate fund or syndicate. And I can't 1031 exchange that interest at some later point. 1031 exchanges only applies to real property, and a partnership interest is not real property. But what I could do is something called the lazy man's 1031. I think we I don't know if we coined that or not, but we've been using that term for a while to kind of help describe this. Basically, it's a 1031 exchange without doing a 1031 exchange, and here's how it works. Let's say that I put however much money into an LP investment, and that LP investment later gives me a big capital gain back because they liquidated, right? So I've got, let's just call it $200,000 of capital gain coming back to me on that K1. As long as in the same calendar year of liquidation, so you actually kind of have to do this before you get the K1, but in the same calendar year of liquidation, so let's say in 2024, let's say right now, today, I get a notification from the sponsor that says, hey, Brandon, we just liquidated this real estate deal. and you're going to get a big capital gain. We expect your capital gain to be about $200,000. I have until the end of this year to go and place essentially $200,000, $300,000 into another syndication. And if I can do that, then I'm effectively going to run the lazy man 1031 exchange, because on that new placement, guess what the new syndication is going to do? They're going to do bonus depreciation, the cost seg study, bonus depreciation. They're going to pass back a large tax loss. So if I can invest in a new syndication that passes maybe 150K of losses back, then the 150K of losses can offset the 200K of income, right? Or partially offset the 200K of income. So I'll have a little bit left over that I have to pay taxes on. Why do we call it a lazy man 1031 exchange? Because you're getting capital gain income from one syndication, but then you're getting capital losses from another syndication. As long as it's in the same calendar year, they will offset. And the new syndication, guess what happens? Your basis is lower because of the depreciation, which is effectively the same concept of a 1031 exchange. You know, you take your basis and you roll it into the next property, but your basis is still relatively the same concept. So that's why we call it the lazy man 1031 exchange. I'm gonna
Before we
skip
move
over
on,
this.
I just wanted to ask and be clear. So I'm expecting some funds back from a few syndications that I invested in years ago. Um, could I take those and invest it into a fund before the end of this year? I know it's different, but the same kind of concept, I would think. So I
Yeah.
can go from syndication to fund and it still be okay.
Yes. Yeah.
Okay,
Yeah.
great.
As long as you have partnership interests, you know, if you're investing in a C corporation, there's some special rules related to REITs, so you do have to be careful on pulling the trigger on the follow up investment. But yes, you can.
Thank you.
No problem. All right, gonna keep cranking. So we talked about the passive activity loss rules. We talked about the LP situation, but let's get back to the passive activity loss rules. How do you avoid the passive activity loss rules? Because again, we want to avoid the passive activity loss rules. If we have a loss from our rental activities, we want to use that loss to offset our regular income, right? That would be fully optimized, not only under the tax code, but the concept of time value of money. We're getting our tax benefit back today, and we can reinvest that tax benefit now. So how do we actually do that? Well, you have to qualify for an exception to the passive activity loss rules. There are three ways to do that. One, sell one of your passive activities. We actually kind of just talked about that, right? One of your LP investments sells, well, you get to use losses to offset the income from that sale. So that's fine, right? So that's one way to do it. The second way is to earn less than $150,000. If you earn less than 150K and if you actively participate in the activity, meaning not in the LP, but you actively participate and you own at least 10% of the activity, you can use something called the special loss allowance, which essentially just gives you a $25,000 allowance to use without having to jump through any other hoops. But you do have to actively participate. You do have to own at least 10% of the activity. The third way to get around the passive activity loss rules is to qualify as a real estate professional. And then the bonus is the short-term rental loophole, which I don't know if we'll really dive into in this presentation. I might just skip over those slides, kind of depending on what time we get to here. So let's talk about real estate professional status real quick. Real estate professional status allows you to overcome the presumption that your rentals are passive, but you still have to materially participate in your rentals. And this is a big deal because you can qualify as a real estate professional simply by being a property manager for third-party clients, or by being a real estate agent for all of your time during the year, or by being a builder or a developer. You can qualify as a real estate pro within those occupations. You didn't hear me say landlord, right? You can do it as a landlord too, but the point is that if I qualify as a real estate pro by being a builder, a developer, a real estate agent, or broker, or any of the other like non-rental real estate businesses, then I can be a real estate pro, but my rentals are still passive. So I still have to materially participate in my rental activities. Very important concept to understand. It's a massive bummer when we get new clients and their prior accountant has, been qualifying them as a real estate professional because they're a real estate agent, but they tell us, oh yeah, my rentals are all professionally managed and I never visit them. I never do anything with them. It's like, well, that's great. You're a real estate professional, but your rentals are still passive. You can't actually use any of the losses. And now you've exposed yourself to some pretty significant audit risk. So you really have to be careful with these are the nuances that I was kind of talking about earlier. And you really have to be careful with this. But first, let's talk about how do you actually qualify as a real estate pro. So you have to spend 750 hours in real property trades or businesses, and you have to spend more time in real property trades or businesses than you do anywhere else. So I have a full-time job. I run this business full-time. I can't qualify as a real estate pro. Anybody that runs a business full-time cannot qualify as a real estate pro. Anybody that has a full-time W-2 job cannot qualify as a real estate pro. Anybody that works 75% of the time cannot qualify as a real estate pro. IRS will just never buy it, right? They won't buy the fact that you're spending more time on working in real estate than you do at your day job or running your business. They just won't. They won't believe that that's a credible argument. So those are the two tests to qualify as a real estate pro. If you can qualify as a real estate pro, and if you materially participate in your rental activities, then your rentals are non-passive, meaning that you can use rental losses to offset your W-2 income or your business income. And then it gets pretty lucrative because we can cost seg the properties, we can run bonus depreciation, we can run big rehabs and bonus depreciate the rehabs, we can run partial asset dispositions. There's so much that you can do. And you can do all that stuff without qualifying as a real estate pro too, to be clear. But once you're a real estate pro and once you materially participate, all of that, all of the losses that creates can be used to offset your W-2 income and your business income. But we have to then talk about what do we somebody just dropped off. we then have to ask, all right, if it's 750 hours and more time in real estate, then what exactly does that mean? Like what are the hours that count and don't count? So in general, if the time that you spend running your rentals don't actually impact the rentals day-to-day operations, then your time's not going to count, right? So listening to this presentation, for example, is not real estate professional status time, because whether or not you listen to this presentation, your rentals are still going to collect rents, your bills are still going to get paid. So this presentation does not impact your ability to collect rents, pay bills. Going on I will not name the company, but a educational cruise for real estate investors is not real estate professional status time, because that educational cruise is not going to help you collect rents or pay bills. It doesn't impact the day-to-day of your rental operations. So if any accountant and there are some out there, accountants and CPAs, and some of them are pretty popular, they will tell you, oh yeah, like all that education stuff, all the research stuff, all that time can count for real estate professional status. They are talking out of their what. They don't understand the nuances to what's actually going on here, and they're going to get you in big trouble. So let's talk about time specifically that does not count. That was kind of the litmus test, but let's go into the details. First bucket of time is investor level hours. So investor hours do not count unless you are involved in the day-to-day management of the rentals, meaning you do not have a property manager and you are running the day-to-day. If that's you, then this bucket of time can count, okay? So this is like an either or sort of situation. But investor level hours are like time spent paying bills, preparing my tax returns, coordinating with my title attorney, my mortgage broker before closing, doing all my research before closing, all my due diligence, all that type of stuff is investor level hours. The bookkeeping, the monthly bookkeeping on my rentals, that's investor level hours. That's not actually day-to-day management type hours. So anything that any investor would do, that's investor level hours. Okay. Any investor is going to do all of those things. Any investor is not going to swing the hammer themselves, manage all the tenants themselves, do all the evictions themselves. That's where you can drive the difference, is the actual management of the property, right? So if you are doing investor level hours, they do not count for real estate professional status unless you manage the property yourself, essentially. All right. The other bucket of time that's not going to count is education and research hours. Again, I don't care what accountants try to tell you that they do count, they are wrong. Education and research hours do not count for real estate professional status. There are two tax court cases that I've got there for you, Half-Poor versus Commissioner and Padilla versus Commissioner, where the tax court specifically goes through both education and research hours. I'm not going to go into those right now, but just know that those don't count. Travel time also, generally speaking, does not count. And I say generally speaking because in the IRS Audit Technique Guide for Passive Activity Loss Rules, the IRS takes a pretty hard stance on there's no travel time that counts. But there is a tax court case, Lay versus Commissioner, where the tax court did allow the taxpayer to count travel time towards real estate professional status. But the difference was that taxpayer had a lot of local rentals and was self-managing them and visited them multiple times a week. And so again, going back to my litmus test of, hey, if I don't do this thing, my rentals will fall apart. That was kind of the stance there. It was like, if this taxpayer did not go travel to the rentals multiple times a week, they wouldn't have collected rents. They wouldn't have paid bills. They wouldn't have fixed the property. So they allowed that travel time to count. So it kind of depends on the frequency and the distance. But in general, travel time is not going to count, especially if it's like couple hours away, you visit infrequently, and it's not really dependent. Like you don't really have to do that thing. All right, that was all negative. Let's talk about positive. So what hours do count? Um, Time spent acquiring the property. Again, if I'm self-managing afterwards, so I've got to be running the day-to-day, showing the property to prospective tenants, placing rental ads, taking applications, screening, negotiating, cleaning the units, maintaining, doing the repairs, doing the improvements, purchasing supplies, inspecting the property, communicating with tenants, collecting rents, evicting, traveling to your rentals. So all that time counts for real estate professional status, counts for material participation. But it sounds like a property manager. So if you look at this list, that's essentially what it is. It sounds like a property manager. So if you have a property manager, you are probably not going to qualify as a real estate pro. Your property manager is the real estate pro, right? Not you. You're the investor. So we have to kind of understand the levels of this. But again, pulling it all together, if I can do this stuff, then I can qualify as a real estate pro. And as long as I can then materially participate, then my rental losses are non-passive, right? And non-passive rental losses offset my W-2 income and my business income because that's also non-passive in most cases. So I get to save a lot of money in taxes. I get to optimize under the time value of money rule. It's awesome. So how do we actually materially participate? There are 7 tests for material participation. Most frequently, we hit the 500-hour test, which is number 1. We hit the substantially all test, which is number 2. And then we hit or we hit 100 hours or more than anyone else, which is number 3. This is an or, not an and. So you only have to meet one of the 7 tests to materially participate. Every once in a while, we will go down that list and get into more complex situations. But generally speaking, our clients are going to hit number 1, 2, or 3 in order to substantiate material participation. Now, participating 500 hours in the activity, there's this concept called grouping. And if you don't do the grouping, then you have to show that you materially participated in each rental separately. Okay. And this is actually something that the IRS will attack. If the IRS knows to attack it, if the auditor knows to attack it, they will attack under audit because it's a gotcha. And if they say, hey, you didn't make the grouping election, then you have to try to prove to them how you materially participated in each rental separately. And typically you can't actually do that. Because it's hard, because you're kind of looking at that 500-hour test, right? Imagine having 10 properties and having to prove that I spent 500 hours in each property. It's 5,000 hours of work on my rentals. That's going to be very hard to prove, if not impossible, I think. So, so the idea, what I'm trying to say is the idea is to make sure that you understand the grouping elections. There's 2 grouping elections, one for long-term rentals and like LP investments in syndicates and funds, and then another for short-term rentals. Make sure you understand the 2. Make sure you have a conversation with your accountant about it. If you missed the grouping elections, you can typically fix it, but once you're under audit, you're kind of toast. So if you have the grouping election made, then you spend 500 hours in all of your rentals. So the same 10 properties where I was just saying you have to spend 5,000 hours on them, now it's 500 hours on all 10 properties combined. And the grouping election is really nice from that perspective, because if you think about it, if I place an LP investment into a syndicate or a fund, that is a rental activity. Okay, that's how the code's going to look at that, as long as the underlying activity is actually buying a rental. So if I do that 9 times, then I have 9 rental activities, but it's 9 LP investments and I'm not materially participating. But one thing I could do is buy a local property that I'm going to rehab, and I'm going to do it myself, right? So now I've got 10 rental activities, 1 actual property, 9 LP investments, but I could spend 500 hours just rehabbing my 1 local rental property, make the grouping election to group all 10 of my rental activities together. And now I've spent 500 hours on my portfolio of rental activities, even though I only spent 500 hours on 1 rental. And that makes all of my LP investments non-passive. Okay. So in years that I'm like placing LP investments and getting large tax losses back, a strategy like that works really well, because I can make that K1 loss coming back to me offset my W-2 income or my business income. All right. So that's how you can use the grouping elections to your advantage, by making it easier to materially participate on all of your rental activities combined. If you don't have the grouping election, though, you do have to materially participate on each rental separately. And if you get audited, the IRS will absolutely typically, sometimes they don't ask about it, But that's also where you want to use an accountant that knows what they're doing, because we were on an audit call recently where we couldn't get our POA signed and faxed over to the IRS in time to get onto the call and actually represent the client, because it was like a last minute sort of thing. The new client coming in asking, desperately for help. Their accountant gets on with them and starts talking about grouping rentals, but they never made the grouping election. So what does the auditor do? Auditor goes, "Oh, grouping. That's right. Thanks for reminding me. Can you give me the grouping election that you guys made?" Couldn't find it. Totally nuked the taxpayer's ability to protect themselves. So you also have to work with competent accountants that, if you didn't make the election, also know not to bring it up. So you just got to be careful in these types of situations. How many questions do we have? I know you guys had some like pre-scripted questions too. Do you want to just start going through those?
Oh yeah. Someone in the chat said, so if you're a GP but have a management company running the day-to-day operations and you only do asset management, for example, managing the management company, do you qualify, or you won't qualify for rep status? So you're managing the management company, and you're a GP of the management company.
Okay, so you're managing the management company and you are a GP
As an
of the
asset
management.
management
Oh,
company.
I see, I see, I see. Okay. Okay. I'm gonna give you the technical answer and then I'm gonna give you the practical answer. Okay. Technically, if you are being on the GP side does not equate to material participation. So what I'm trying to say is, if you're on the LP side, you generally are blocked from materially participating, and the IRS will take that stance. If you're on the GP side, you can have the opportunity to materially participate, but it does not equate to material participation. Does that make sense? So you still have to meet one of the 7 material participation tests, even if you're on the GP side. Then the question becomes, well, how do I do that? Right? You're probably going to have to you're probably going to have to do the 500-hour test. You're not going to be able to do test number 2 substantially all, because there's other people participating, not just you, right? Or if it is just you, then great, you win. You don't have to spend 500 hours. But on most of these, I'm a GP, Mike's a GP, Deanna's a GP. We're all in it together. No single one of us is going to be substantially all the participation. We're all participating. The other test, 100 hours more than anyone else. If the 3 of us are all in this together, and we all know 100 hours more than anyone else, what are we going to do? We're going to try to outwork each other, right? So what happens in partnerships is you're typically looking at the 500-hour test. So on the GP side, we don't just automatically get material participation. We still have to meet one of the tests, and we're typically looking at the 500-hour test. Now, how do you get that, right? That kind of depends on your role in the syndication. So the technical answer that I'm going to give you is, if you are an asset manager, you're probably doing the investor level hours. You're probably not involved in the day-to-day management of the activity, which means that you probably can't qualify as a real estate pro. Those hours probably will not count. Now, the practical answer is, we've never seen an IRS audit that tries to attack that. We've also never seen a tax court case that rules against GPs and syndicates and funds. Why? Probably because you're on the GP side of the syndicate and fund, and it's just not worth the time or the resources for the IRS to try to split hairs. But I do think that so practically, yeah, fine. Technically, I don't think it works. So somewhere in there is your own tolerance of risk.
Not black or white.
Yes.
Let me chime in with the next question, Brendan. So again,
Sure.
great information. So our REP, 750 hours grouping election with 500 hours of material participation is absolutely wonderful. We have a lot of investors. It's just so hard to do. So that's what you just said. So a number of questions that we have heard are really about successful business owners that have active businesses. They own dental practice, doctor's office, multiple offices, etc. And they basically at some point want to, let's call it, get ready to retire, or retiring, etc., etc. So they're selling essentially, you got 2 components. You got the business, and then you got the real estate. Quite often, real estate is used for the business. So they were active in the business. And then they are real estate investors. And these two things, one is passive, the other one is active.
Yeah.
So is there anything that can be done to do something clever?
Yes.
Perfectly by the book. For example, I've heard of DST, not a specialist. I don't know if it's worth selling active things into putting into DST and then invest passively, and at some point essentially using DST as a way to shield taxes until investments become all passive. Well, it's an open question on the strategy. It's not an exact answer. It's just more of a how do you turn
DST being deferred sales trust or Delaware statutory trust?
Delaware statutory.
I guess both. The question is dual. Which one would it be? Because DST is used in exactly both connotations.
Yeah. So Delaware statutory trust a little bit different, but a deferred sales trust is typically very in line with a monetized installment sale, and that is currently on the IRS Dirty Dozen list. I would stay clear of those. Would not invest in them, and would recommend avoiding them at all costs. Now,
just to be clear, this is deferred sales trust. You do not like it. It's the red alert list.
Yes.
IRS wants to fire their phone and torpedoes of that.
Yes. Rightly or wrongly, you will end up paying a lot in legal fees to defend yourself. So would just avoid. Not worth the tax savings. Now, let's talk about what we can actually do here. So
Delaware statutory trust.
Yeah. So let's say you're a business owner and you have real estate. The first thing you should do always is consider grouping the real estate in with your business. You do this under Treasury Regs 1.469-4. Okay, we call it the -4 election. And what you do is basically, if I'm like a dentist and I have an office that I also own, I make this grouping election. I can run a cost seg study. I can bonus depreciate the actual office, and I can use the tax losses to offset my dentist income without having to qualify as a real estate pro, without having to materially participate in the office activity itself. So any business owner that is owner occupying an office, you guys have this like amazing extra tax benefit that frankly we see missed a lot. But it's an awesome benefit. And even if you have missed it in the past, you can grab it today or tomorrow, like you can still correct it and get it done. So that's if you're currently operating now, and that'll save you a lot of money on the dental income taxes. Now, when you are liquidating, the real estate piece could be 1031, right? So we can 1031 out of the real estate. We can buy more real estate. Typically, we see people go into the triple net lease space because they're trying to be more hands off. So they'll 1031 and roll into a medical office or something like that. And then the actual business activity itself, typically when you are selling a business, you have to make a determination between, is it worth taking the cash up front and taking a tax hit, or doing some sort of installment sale or buyout. And those both have varying degrees of tax consequences and varying degrees of risk, right? The risk of the buyout and the installment sale is that the new owner blows it all up and I actually don't get paid. So how do I balance that between taking the tax hit today? But if you can like plan on this, we call this transaction analysis. So if you can plan on these transactions, we can do transaction analysis multi-years in advance and essentially tell you this is exactly what type of real estate you need to be purchasing. And this is exactly what you need to do in that real estate in the year that you liquidate to ensure that we can use rental losses to offset what you have going on. That could partially be invest in syndicates and funds. It would partially also include buying your own rental real estate that you're going to materially participate in. And people will go, well, I don't want to do that if I'm about to retire, and that's fine. Don't do it, but you won't save a crap load in taxes. But sometimes when we show, well, you only have to do it for a 6-month period of time, all of a sudden people go, well, okay, I can do it for 6 months and then I'm out, right? And if you're talking about saving $1 million plus in taxes, all of a sudden it gets pretty nice looking. So there are ways to do it, but I guess in summary, what I would say is if you know that event is coming, have a conversation early or earlier in the process so that you can understand what moves you need to start making today to eventually, like what we're trying to do in that case is build a portfolio where we can essentially nuke your income in 1 year. It's like we can just flip a switch and go, bam, this is the year we're going to do it. So we just try to help you understand what that looks like, what we need to build to. So when you're ready to pull the trigger, it's all available to us to use.
Thank you, Brian. A lot of wisdom here. Basically multi-year planning is critical. Don't just go wake up one day and say, "Wait, I got to fix the problem today," when it's hard to fix it on a short notice.
Yes.
So another quick question. When they do 1031 exchange out of, let's just call it real estate that they actively their practice was located in the same building, and they use the cost seg benefit of the technique. Just to be very clear, they can own the real estate through one entity and then the business through another entity, but group it together as a
Yes.
single tax.
Yes. Yes.
Okay.
There are nuances to that, but yes.
Okay, that's wonderful. And then the 1031 would essentially move that real estate component from active into something passive that they can 1031 into.
Yep.
Can they, I guess, but they can't use passive losses. So they can't get passive property bonus, depreciate that, participate in a syndication with bonus depreciation because the one is passive, the other one is active. So they actually need to do 1031 into something that's passive. I don't know how long they have to wait there, but as long as they've already moved into a passive asset at some point, now they can use that technique you outlined earlier where you can sell and get the passive gains. I like the terms pigs versus pals, passive investment gains, and then you get passive allocation losses on the new bonus, and then they offset. So a little bit of planning is required. Any quick comments there?
No, I think you've got it perfectly right. The one comment that I will add, as you were talking, I remembered one of the questions that you had kind of sent over a few weeks ago was on depreciation recapture. So if you like what we're essentially doing is we're creating timing differences in your tax recognition journey. Okay, so we are trying to reduce taxes today. We're trying to get the tax savings. We're trying to reinvest those tax savings today and let them grow and build wealth, right? But eventually, as you do the 1031s, you're going to end up with this large portfolio and you might start just liquidating it. When you start liquidating, you're going to have depreciation recapture because depreciation is not a permanent benefit, right? It is a temporary benefit. So I get to depreciate today and I get to save money today. But when I sell later, I'm going to pay it all back. And so here's kind of how it works in very simple terms. Let's say that you buy a property for $100,000. You buy a rental, single family home for $100,000. You sell it later for $105,000. Most of the time when I do this like presentation, I'll trick everybody, right? I'll say, okay, who thinks that we made $5,000? Raise your hand now. Everybody raises their hand. I made $5,000, right? But then I go, yes, you did make $5,000. However, your annoying accountant is going to say, how much did you depreciate the property? And then you're going to say, well, 20K over the hold period, right? That was my depreciation that I claimed. So your annoying accountant goes, well, your adjusted basis is actually $80,000, 100K minus 20, right? So if you sold it for 105, your actual gain on sale is 105 minus your adjusted basis. So you have a $25,000 gain on sale. 20,000 of the gain is coming from depreciation. 5,000 is coming from appreciation, right? So the 20 coming from depreciation is called depreciation recapture. It's basically gain that was created thanks to depreciation. And if you actually run that example back, let's say you bought the property for 100 and you sold it for 95. Again, trick question, how much money did we lose? People go, oh, we lost $5,000. And I go, yeah, until your annoying accountant again asks, how much did you depreciate the property? And it's $20,000, right? So our adjusted basis is 80. We sold the property for 95. We actually have a $15,000 gain, right? Kind of weird, but that's how it works. So you just have to remember, if you're claiming depreciation, you do have to pay it back at some point, unless you 1031, or lazy man 1031 until you die and you just pass everything on to your heirs. Because when that happens, they get a stepped up basis in the asset equal to fair market value. So all the depreciation goes away, all the capital gain goes away, and they get to sell it if they want to at the fair market value, pay $0 in taxes. So you can actually eliminate it. You can make it a permanent benefit. And that's when we start including trusts and estate planning and all that type of stuff. Because one thing that we're actually finding is a lot of the kids don't really want to manage the real estate portfolio. So what do you do, right? how do you still get all those tax benefits locked in, but then also give them the ability to not have to worry about managing the portfolio? It's kind of an interesting scenario.
What about opportunity zones? Is there any way to go into that or roll into it? And I know it's like a 10-year commitment. And do you know much about them?
We do. Yeah. We have a guy on our team that's really good at them. I wouldn't say I'm an expert at them, but we have quite a few clients that use opportunity zones. A lot of people stopped investing in opportunity zones once the 5-year and the 7-year benefits were phased out. But I think that what a lot of people don't realize is that 10-year benefit also eliminates depreciation recapture. So it's super lucrative. So if you don't mind taking a little bit of extra risk and you're investing in opportunity zones, sometimes people are investing in opportunity zones and they don't even realize it. The IRS has a census tract that you can go download. It's a big Excel file. And so I did this for Raleigh, North Carolina, because I was just kind of curious. I was shocked at the neighborhoods that are considered opportunity zones. It's not what you would think. So if you have any interest in that type of stuff, I would highly recommend that first you go and find that census tract on the IRS's website. It's just like a CSV file that you can download and look up around you. But two, if you're finding areas that's like, oh yeah, I don't mind investing there, definitely have a conversation with your accountant about setting up a qualified opportunity fund. You can do it with your spouse. It doesn't have to be like a massive thing. So yeah, it's pretty flexible, and the benefits are still there as long as you're willing to hold for 10 years. They're still cranking. And I think that so our QOZ expert in the firm is thinking that this fall, or sorry, this winter post election, once the bipartisan tax bills pick back up, they're thinking that we're probably going to get some insight as to whether or not opportunity zones are going to be killed or extended. So maybe wait until that happens. But yeah, it can be very lucrative.
Yeah, I have invested in some, and it's been a great investment so far. Like you said, I was surprised the neighborhood that it was. It's a very nice area, and we built a brand new apartment complex there. So
Cool.
I have several questions I want to get through. I know we have just a couple minutes left. So are there any options to reduce your W-2 income taxes as an LP investor?
If you are just investing as an LP in these syndicates and funds, then the answer is no. You can't use the losses to offset your W-2 income, with the exception being if the syndicate actually loses you money, then the losses could be used to offset your W-2 income, but you'd have to wait until it goes full cycle. And then the one other exception would be kind of that situation that I was explaining earlier. If you actually buy a property local to you and you dump a ton of time into that property, you qualify as a real estate pro, you meet the material participation test on that property, and you can make the grouping election to group in all of your LP investments. We have a few clients that do that. So they'll buy like a couple properties local to them, they'll self-manage them, they'll do a big rehab, they'll meet all of the hour requirements, and then they'll just make a grouping election to pull all of the LP investments into that activity as well. And that makes them all non-passive at that point. So you can do it, but you do have to put forth the effort. So if you just want to be totally passive, you're not going to be able to use them to offset your W-2 income.
Someone asked in the chat why I would want to list my syndication in my REP grouping. Can you tell me again?
Why would you want to do what?
List my syndication in my real estate professional grouping.
I'm not fully understanding the question.
Yeah, I guess if they're already a real estate professional, why would they want to list their syndication and part of that grouping? I don't know if
Oh yeah. So here's why. So let's say that you are a real estate pro and you've got 5 rentals and you qualify as a real estate pro. You meet the 750 hour test and then more time in real estate than anywhere else, just by managing those 5 rentals that you have. You self-manage, they're all local and they're pain in the butt to manage. You also materially participate in those 5 rentals, right? So those are all non-passive. The losses can be used to offset business income, W-2 income. But if you're also investing as an LP, that is still passive. You can't materially participate in an LP investment. So that's still passive. So if you make a grouping election to group the LP in with your rentals, now you make the LP non-passive. So now you can use the LP losses to offset whatever other income you have. Now, some people, if their only income source is from passive activities, and that could be also from your rentals, then you can go and invest in LPs and not have to even worry about all this because, again, passive losses offset passive income. So it just kind of depends on your situation. But yeah, if you can, the answer to your question would just be, why would you do it? You would do it if you could make the LP losses non-passive, and if that offset W-2 income or business income for either you or your spouse. Like you could do this for your spouse too, right? A lot of times we have one high income earner, and then we have another person that's not the high income earner. They're either part-time, stay at home, whatever. It could be husband, could be wife, right? Doesn't matter. That non-high income earner goes out and manages the portfolio. They qualify as the real estate pro. Now all that depreciation, all the losses can be used to offset the high income earner income. So there's benefits to it, but again, it is nuanced, and you just want to make sure you've got a good strategy.
Do you have any pros and cons of accelerated depreciation?
I will tell you, I get into arguments about this with like CPAs all the time. CPAs are like, oh, we shouldn't just say blanket, like accelerate, depreciate everything. And honestly, I think that that's wrong because I think you will be correct 999 times out of 1,000 when you say cost seg and bonus depreciate. I think that you will be correct. Now, there are instances where it does not make sense to run accelerated depreciation. The two that I can think of off the top of my head are if you are going to sell the property within 12 to 24 months, that accelerated depreciation, the tax savings that you get from that just won't have enough time to be reinvested and grow. So there is a break-even analysis because the cost segregation studies to do this are not free, right? So you do have to pay for that. So there is a break-even analysis. So you do want to give your tax savings time to grow. So a short-term turnaround is not very good. If you don't qualify for an exception under the passive activity loss rules, and you don't have a lot of passive income, then that's probably the other time that it's not good because you'll buy a property, accelerate the depreciation, just end up with a really large tax loss that you can't use. So that's not great. But even then, like I partnered with my parents on, my wife and I, let's just say, partnered with my parents on 10 duplexes. So we got 10 duplexes, and my parents could be my dad specifically was a real estate pro because he was doing all the work. He was retired. And so we did a cost segregation study on the properties, and he and my mom used all the losses that were allocated to them, but my wife and I could not use the losses because neither one of us was a real estate pro in that year. So there's still times where it's like, well, even then it doesn't help me, but it helps my partner, right? So I would just say it's rare for the answer to be, let's not do this.
Let's
Let me
imagine.
chime in with a quick
Sorry, go
question.
ahead.
Sorry, I'm just trying to chime in one quick question. A really tough question.
Yep.
So you are active in your business, and at some point you want to retire. How long does it take from the active to go to passive? In other words, you are a business owner. You're not selling the business. You want to retire. You want to, and you basically at that point want to transition to passive owner or part owner versus a active participant. Just curious how long it takes.
So you would be looking at, I believe, probably test 5 there.
5 years?
No, you'd have to go 10 years, I think. So the problem is going to be test 4 and 5 with this. All right. So the question is basically like, all right, I've built a business. I was materially participating, and I replaced myself as the CEO, and I'm no longer participating in the day-to-day. Maybe I'm on the board, or maybe I'm not on the board. But I've still got a stake and I still get income from it. The problem is first going to be test number 5. You materially participated in the activity for any 5 of the last 10 years. Okay. So you're going to have to essentially go 10 whole years out. No, you're going to have to go 11 years out and not have participated in the last 6 years. Okay. So it's like a look back, right? Because the IRS doesn't want you to do this, or the Treasury doesn't want you to do this. They don't want you to convert my business income to passive at some future point. So they're going to basically make you go a whole decade, and they're going to do this look back study when you start doing this, and they're going to say, hey, look, if over the last 10 years you materially participated in any 5, then you are still materially participating, even if today you're not materially participating. So that's the first thing. So you'd have to go 11 years first. That way, on year number 11, when they look back over the last 10, they see that you participated 4, but you didn't participate 6. So now you're good there. But then the second issue would be test number 4, significant participation activities. A significant participation activity is an activity that you spend 100 hours in. And it doesn't matter if you outworked anybody else, you just spent at least 100 hours in. So if you spend 100 hours in this activity and you also have other activities that you've spent 100 hours in, and collectively they equal 500 hours, that's what test number 4 essentially is saying, then you have also materially participated in that significant participation activity. So you would really have to dial back your time in this activity. I mean, even if you were on the board, it would probably still be a significant participation activity. And then it would just be a question of, did you have other significant participation activities too? So those are the 2 traps. Test number 4 and 5 would be the 2 traps for that. Yeah.
Thank you,
Let's
Brian.
imagine you're some kind of a tech exec or an engineer or something, and you've had a significantly appreciated stock portfolio, and you want to sell it all and invest it into income-focused real estate, like our Tempo Income Fund. What's the best way to convert net worth to cash flow, in your opinion?
I would probably sell slowly. The problem with investing in the fund is that if the fund produces losses, you're not going to be able to use the losses to offset the sale of your stock, because stock sale is capital, and the losses are ordinary losses, not capital losses. Additionally, the losses are passive, and the stock sale is going to be considered not from a passive activity, which basically means it's non-passive. And it's weird, but that's how these rules are written. So the rules are truly written to prevent people investing in real estate to use those losses to basically offset any other type of income and gain on sale of stock. So if you've got a whole bunch of like RSUs or options and you're trying to liquidate those and extract all that wealth, I would say either over a multi-year strategy or just liquidate it all and then try to buy your own real estate and create losses. But even then, you have to worry about the excess business loss rules, which cap your losses at 500K. If you're married, 250 if you're single. So it can really get nuanced fast with that type of stuff. Yeah, it depends on people's goals and their risk tolerance too, because it kind of going back to that earlier buyout situation. It's like there are some of these situations where it's like, hey man, Nvidia's peak, let's just liquidate it, move on with our lives, take the tax hit. Or it's like, like we think that this is going to be, we're just going to sell over 5 to 10 years and spread the tax hit out. Yeah.
Just to clarify, it's better to invest post-tax money or
Well,
find something that will defer the tax.
yeah, I would always say don't pay taxes. So we always want to try to find ways to not pay taxes, right? But we have to look at what our capital sources are, what we have available to us, and that will inform the strategy. If we can avoid paying taxes, we won't pay taxes. Yeah, if you can do that, and that's why I like the passive activity netting idea, because over time you end up creating this kind of like circular wealth building that you never pay taxes on. So you continuously increase your wealth, but you don't increase your taxes.
Follow-up question on this line of thinking. So this has been discussed many times. Is it better to pay some tax instead of going sort of very sophisticated structure and trying to avoid, even though your preference is to avoid? In other words, I've seen people do this. They'll move from New York or California to, let's call it Florida, or to Texas, one of these no state income tax. And then if you're sitting on appreciated stock portfolio, just sell after you moved and then invest post capital gains tax.
Yep.
What do you think about this? It is a very simple strategy. It's incredibly simple, but it is one of these ways where you're not overcomplicating your life and you are paying tax, but capital gains, and you're no longer in New York or California.
Yeah.
And you just have to establish residency and then make the move. What do you think?
Totally doable. Comes up time to time in our practice as well. I am my general mindset is the point of being rich is to live anywhere you want. So make that decision first. Don't make decisions squarely based on taxes. I mean, we've had clients move to Puerto Rico and then become totally miserable. So it just depends on your individual goals. But yeah, if you are like, if that was in your plan, like I don't want to live in this city once I'm done, then let's establish residency somewhere else before we liquidate everything. 100%. Yeah.
Thank you.
Someone in the chat said, so rep benefits active real estate operators with offset / combined non-real estate investment / incomes, not the other way around.
Correct. Real estate professional status is going to benefit you if you're actively operating a portfolio. Yes. Yes.
Okay. And then, so you don't have to have any other real estate business, otherwise you don't qualify. Rep status means you don't have any other non-real estate business, otherwise you don't qualify. Only helps combine.
No, you can have other businesses. You just have to spend more time in real estate than anywhere else. So if I dialed my CPA firm back, for example, in any one year, to, well, let's say like next year, I say, hey, I call my CEO up and I'm like, hey, I need you to step up. I'm going to take like half the year off, or I'm going to work 20-hour weeks or 15-hour weeks, because I'm going to go qualify as a real estate pro. I can do that, right? As long as I can show that I only spent 15, 20 hours a week running my business, that's 1,000 hours a year, right? Running my business. I can then show that I spent more than 1,000 hours a year in real estate. So if I do that, I would have hit the 750-hour test and also the I spend more time in real estate than I do anywhere else test. So you don't have to divest from businesses and things. You just have to think a little bit about how am I going to drive the benefits home here.
Just to clarify on that point, which you just described is an example of, call it occasional real estate pro qualification. You don't have to be real estate pro every year,
Correct.
but the year where you really need it for whatever reason,
Correct.
where you're going to write significant big checks into the deals with heavy bonus depreciation. And then you can, in that year, qualify as real estate pro by stepping away from your business, turning to rentals, running them yourself, documenting everything, and then doing the grouping election, taking these passive losses into essentially from the investments into grouping with the active material participation on rental properties. And in that year, you're wiping off a lot of tax liability. I assume that's a very viable strategy, but it's hard
Right.
to maintain because you have to essentially be constantly spending more time in real estate than in anything else.
Yes, 100%.
Very good.
Okay, if there's any last questions, please feel free to reach out to Brandon. Brandon, you are accepting new clients right now or no?
Always.
Yeah? Always. Okay. And you have a huge team, like 80 people, right?
Yes.
Huge
Very large.
team.
Yes.
So
It's
they
been a
have
lot of fun.
specialty in like every direction of real estate. So that's
It's
awesome.
actually been really cool. The larger that we've gotten, so we've gotten a lot more recognition in the industry, and that has enabled us to attract really, really smart people, to the extent that we had a team trip in Disney where I flew everybody out this past April, and told my COO after the trip, I was like, I'm a little scared, man. Like, I've never been scared running this business, but I was like, I'm a little scared because like we have to keep growing to give these guys opportunities and women opportunities. Otherwise, they're not going to stick around. So you're just like, and these people are smart. So yeah. Anyway, it's been fun. It's been a lot of fun growing this thing. Yep.
Yeah, I've seen some of your webinars. They're fantastic. Great, great. I bought one of them because I want to go back and refer to it later. So very good information to have. And this recording will be on not Facebook, but YouTube. But follow us on Facebook, YouTube, LinkedIn, all those things to keep up with what our latest lunch and learns are. Thank you, Brandon. We really appreciate your time. Thank you so much for joining us and answering all these questions. There are so many, I know, nuanced questions. So please feel free to reach out to Brandon and ask your specific questions. I know I have a weird one I want to ask you offline. So
Bring it on.
is there an app or a good way to track real estate professionals is the last question we're going to have on
Uh, I mean, there's apps out there. We actually just won an audit with somebody that was using Toggle, Toggl. And the auditor was impressed with how detailed the log was. So there you go. But otherwise, no, I mean, you don't have to, you can use an Excel spreadsheet, Google spreadsheet, you can use a Google Calendar, you can use a handwritten notebook. It doesn't matter. What matters though is that you log every single time that you work on your rentals and that you leave detailed notes. So some of the audits that we're struggling with, their accountants did not advise them on this, and so they're building their time logs retroactively only once they're under audit. And it's really hard to leave detailed notes at that point. And the auditors just see your lack of detail and they just dive right into it. So it just becomes a really hard thing to start defending. So as you're going, just think about yourself 3 years from now. How can I set my 3-year future person up for success? Because that's about when that audit would come down. So be detailed today. Attach your receipts to the time log today, just to fully document everything.
That's great advice. And your newsletter has great advice and
Thank you.
stories, all kinds of things. I've been reading it and keeping up. The one today was really interesting too.
Oh yeah,
Um,
yeah.
And I know you have your own opinions and things to say about the upcoming election, but I just want to share our next Lunch and Learn is Friday next week. You might actually want to watch, Brandon. Frances Newton Stacy is going to be our guest. We're really excited about this. She's going to talk about the market outlook and the election impacts and all of the yield curve and things that we talked about on our panelist discussion recently, but in more detail, all about what she's seeing. She's an analyst and a strategist, and it's going to be a great webinar. So I hope you guys come back next Friday. I know it's kind of a back-to-back week like this, but again, it's on our YouTube, so please subscribe, and so you'll get that latest video. Thank you everyone for attending today, and I hope you have a great weekend, and we'll see you next time.
Thank you.